Ladies and gentlemen, Asian guy here. I am here to tell you that the price you see on the screen is the least important thing that happened today. If you're focused on the $95 all-time high, you're missing the signal. You're looking at the scoreboard while the entire paper stadium is burning down. Because the real news today isn't a number, it's a document. And that document is an official government decree from Beijing. While we were watching the charts, while the algorithms were fighting over cents to get to $95, the People's Republic of China quietly issued new industrial and trading licenses that have changed the trajectory of this market forever. Now, to the uninitiated, this sounds like boring bureaucracy. It sounds like an observation, but you have to understand who is speaking and what they are doing. This is not a hedge fund manager talking about his quarterly bonus. This is not a CNBC pundit trying to get clicks. This is the government that controls the largest refined silver output on Earth. The government whose industrial base runs on this metal. Silver is the most critical conductive metal for the new economy, for solar, for 5G, for next-gen defense. It is not optional for high-tech industry. Physics does not negotiate. So when China implements this new licensing system, they are not talking about paper fees. They are worried about availability. This new license system means, I'm worried I cannot keep the metal domestic. This new license system means, my strategic supply chain is at risk. This new license means the paper market is lying and the physical vaults are about to be blockaded. This is the moment the narrative shifts. For the last 5 years, we have been fighting a financial war. It was the retail investors versus the short sellers. It was a game of paper leverage and short squeezes. We wanted the price to go up. They wanted the price to stay down. It was a casino game. But as of this morning, the financial war is over. The industrial and geopolitical war has begun. When the largest global refiner of silver publicly locks down its own supply, we move from speculation to survival. China cannot print silver. They cannot derivative their way out of a shortage. If the rest of the world doesn't have the physical metal, assembly lines stop. The credibility of the COMEX crashes. Do you understand the difference? If the COMEX is short silver and the price goes up, they write a check. It hurts, but they survive. If Samsung, Tesla, and Western solar manufacturers are short silver, and the supply runs out due to this Chinese blockade, they lose production. They cease to exist as functional manufacturers of future tech. China is signaling to every other industrial nation, to every other CEO, that the scramble is on. They just fired the starting gun for massive corporate stockpiling outside of their borders. Before today, these companies operated on just-in-time inventory. They kept a few weeks of silver on hand because they trusted the COMEX. They trusted the London vaults. This new Chinese policy tells them that trust is gone. They are looking at the same data we are, the deficit, the inventory cliff, and they are realizing that just-in-time is about to become not in time. And when industrial giants start hoarding, the price creates a vacuum. They don't bid up by cents, they sweep the order book. They buy everything at $95, everything at $105, everything at $110. This is why we hit $95 today. The market is front-running the inevitable corporate and national panic. The $95 all-time high is not a bubble. It is the market waking up to the fact that the price has been too low to incentivize new supply for decades. And now the users are paying the price. Silver has been treated like a paper toy for 40 years. Today, it reclaimed its status as a critical strategic asset. The price is rising because the people who actually need it are realizing that the paper markets have been lying about how much they have. But here's the most terrifying part. This Chinese move isn't just a general tightening. It is focused on a specific date on the calendar, a date that is hitting the global supply chain right now. China knows something that the mainstream media is ignoring. This new export license system is not just a bureaucratic rule change. It is a blockade. And when you understand the details of what China is about to do, the specific thresholds, the credit requirements, the nationalization of supply, you will understand why $95 silver is a gift. Because what is happening in Beijing right now is the checkmate move against the Western industrial complex. And that brings us to the specific nightmare that is keeping CEOs awake at night. It is a nightmare you can see burning right behind me in the thumbnail. Look closely at the image. You see stacks of paper, COMEX silver contracts going up in smoke. And there, etched onto the frame, is a price point, an old tombstone, the $81 price tag. That is not just a historical number. That is the symbol of the immediate past. That $81 price represents the decades of manipulation, the lie, the sheer fraudulent genius of the fractional reserve paper system that has kept physical silver artificially suppressed. It is the cost basis for the paper short sellers, the final stand for the bullion banks who swore they could conjure metal into existence with a signature and a computer entry. But their promises are now nothing more than ash. Why? Because the $95 all-time high that we just smashed. That is the final hammer blow against that $81 delusion. It is the moment the paper lie became financially indefensible. Think of it this way. For 40 years, the COMEX and the London Bullion Market Association, LBMA, operated under a gentleman's agreement with physics. They knew they only had maybe 1 physical ounce for every 300, 400, or even 500 ounces they sold on paper. They bet their entire business model on the assumption that you, the buyer, would never actually ask for the metal. They were running a giant confidence game. But when the price hits a critical psychological barrier like $95, something fundamental snaps in the market's collective consciousness. The momentum becomes self-feeding, and the retail investor, the institutional buyer, and the industrial entity all simultaneously realize the same terrifying truth. The emperor has no clothes. The $95 ATH isn't just a new high. It's the sound of demand accelerating faster than the short sellers can print paper. For years, the banks could easily absorb the demand. They would sell a massive amount of paper short, push the price down, and then buy back their shorts later at a profit. That was the game. But as global industrial demand for solar, electric vehicles, and high-tech defense systems exploded, they hit a wall of irreplaceable physical demand. The decade of shorting and suppression has created a massive, compressed spring, and the 95 trigger just let it loose. They are now in a panic, desperately trying to short into a void where physical silver is vanishing, and the leverage they relied upon is turning into a lethal countertrade. You see, the core function of the COMEX silver futures contract, the contract shown burning in our thumbnail, is not to facilitate price discovery. Its core function is to facilitate price suppression. It allows a small group of highly capitalized players to flood the market with unlimited paper promises, driving the price lower than it would ever naturally be, given the geological scarcity and accelerating industrial needs. But the market has finally reached the point of absurdity. The ratio of paper promises to physical ounces has become so laughably high, some estimates put it well above 350 to 1, that the whole thing is an unstable fractional reserve time bomb. The $95 ATH proves that the demand side is now so overwhelming that the supply of new paper short contracts is no longer sufficient to stop the momentum. The lie is no longer working. Think about the implication of the ATH. It is the market finally starting to do the job the manipulators prevented it from doing for decades, rationing supply. The fundamental failure of the COMEX paper value is that it has no basis in physical deliverability. When silver was at $20, industrial companies could afford to stock up, and the retail public mostly ignored it. But now, at $95, a new phase of price action begins. This higher price is no longer just a financial windfall for investors. It is a painful economic necessity. The price has to move up to ration supply, to slow down the ferocious demand from solar panel manufacturers, from EV producers, and from the new defense sector. The paper market tried to hold the line at $81, but the combined weight of unstoppable physical demand, coupled with the geopolitical scarcity manufactured by China, shattered that line and sent the price screaming to $95. This $95 level, therefore, is not the peak of the rally. It is the confirmation of a fundamental structural change. It is the price point where institutional money, which used to be religiously shorting silver, now looks at their models and realizes they must pivot. They must realize that every time they try to short paper, they are just accelerating the run on the vault and pushing the price closer to the ultimate target, $120. This is the price level necessary to clear the industrial deficit, to force high-cost mining projects to become viable, and, most importantly, to properly reflect the geopolitical risk injected by the new Chinese licensing system. The burning paper in the image is not a metaphor for a loss of money. It is a funeral pyre for the failed mechanism of Western financial control. That mechanism, the COMEX silver futures contract, is failing because it can no longer contain the physical reality of a world starving for metal. The price is moving up to ration, and the first stop on that rationing highway is $120. And that brings us directly to the strategic checkmate move that pushed us past $95 in the first place, the Chinese Guillotine. And that brings us directly to the strategic checkmate move that pushed us past $95 in the first place, the Chinese Guillotine. And that brings us directly to the strategic checkmate move that pushed us past $95 in the first place, the Chinese Guillotine. But before we dive into the geopolitical horror show that is the new Chinese license system, we must fully internalize the implications of the $95 signpost. We need to look at this number not with the emotion of a speculator, but with the cold, hard logic of market mechanics. Because I am here to tell you that $95 is not the top. It is the final confirmation of a new, irreversible momentum wave. It is the beginning of the shock phase, and the required price to end this crisis is already etched in the fundamentals, $120. You have to understand the psychology of a suppressed market break. When the price has been violently held down for decades, the moment it breaches the previous resistance, it doesn't just crawl higher, it explodes. The $95 ATH is confirmation that the decades of supply deficit, the slow, grinding depletion of above-ground inventory, has finally reached a critical mass. The price action you're seeing is purely a reflection of a system that needs to find a new equilibrium. A price that is so painful, it actually reduces the demand to meet the rapidly dwindling supply. This is called price rationing. The price is the only thing that can fix the physical shortage. Why $120? This is not a random number plucked from thin air. It is the necessary price required to achieve two critical goals simultaneously. First, it is the price required to properly incentivize new supply. Silver mining is complex, capital-intensive, and often a byproduct of other metals. The current price has been so low for so long that investment in new primary silver mines has been virtually zero. When you factor in inflation, permitting, and the cost of bringing difficult low-grade deposits online, the actual true cost of production for a new dedicated mine is well into the triple digits. $120 is the level that screams to global mining CEOs. Stop what you are doing and allocate capital to silver now. It is the price required to flood the market with hope for future supply. Second, and more immediately important, $120 is the price required to genuinely clear industrial demand. At $95, big industrial players, especially those in solar and EVs, are panicked, but they can still largely absorb the cost increase and pass it on. At $120, however, the financial calculation changes dramatically. Marginal or less efficient users are forced to sideline their projects, or perhaps, desperately, search for a less efficient, more expensive substitute like copper. The $120 price acts as a violent, immediate brake on industrial consumption, thereby allowing the supply that is available to be allocated to the most critical, highest value uses. Think military, aerospace, and cutting-edge medical tech. $120 is the industrial floor, because that is the level where the global assembly lines are forced to slow down. This realization is the true core of the shock phase. Institutional money, the massive hedge funds and pension groups, are not in the business of emotional investing. They operate on models and risk-reward ratios. For the last 2 decades, their model told them to be short silver, betting on the paper suppression system to hold. But the moment silver punches through the 95 ceiling, their risk models flip from short to survival. They see the geopolitical tension, they see the supply deficit, and they realize that maintaining a short position is no longer a trade. It is an existential risk to their portfolios. They must pivot from being short paper to becoming aggressively long physical metal to survive the inevitable blow-off top. This mass pivot, this frantic rush of smart money abandoning the short side, is what creates the legendary blow-off top phase. We have historical precedents for this. Look at what happens when other strategically important commodities break free of years of suppression. Think of the 1970s oil shocks, or the early 2000s when gold finally broke free from its decades-long paper ceiling. When the fundamentals become too distorted, the catch-up phase is not linear, it is parabolic. The price doesn't gently appreciate by 10% a year. It creates a vertical spike that wipes out the short sellers and reprices the commodity in a matter of months. This is the final capitulation of the paper system. The $95 ATH is the starting point of that parabola. We are now in the explosive midsection of the S-curve, where everyone who has dismissed silver as a relic suddenly realizes it is the single most critical industrial metal of the 21st century. The algorithms are already programmed for this parabolic move. They are seeing the same inventory drain data we are. They are seeing the failure of every single short attempt since $81. They know that once the institutional herd starts running, they will not stop at $100. They will run until the fundamentals stabilize, and that stability point, the point of industrial equilibrium and supply response, is $120. This target is not about greedy speculation. It is about the cold, hard math of a global market correcting a 40-year manipulation. And make no mistake, the true accelerant for this run, the fear that drove us past $95 and will catapult us to $120, is the unholy alliance of accelerating demand and the deliberate strategic strangulation of supply coming from the East. It is the Chinese guillotine that turns this financial trade into a matter of geopolitical survival. The short side of this trade, the bullion banks and the desperate paper shorts, are about to experience a margin call of historical proportions. They are watching the same signs: the accelerating depletion of registered COMEX inventory, the decoupling of Western and Eastern prices, and the absolute failure of the $81 paper line. They are now playing defense, hoping they can survive the inevitable surge past $100, but the math is against them. They are facing an army of physical buyers backed by the strategic actions of a sovereign state. The $95 signpost simply marks the exit ramp from the paper world. Our destination, marked by the industrial necessity of a new, sustainable price, is $120. The short side of this trade, the bullion banks and the desperate paper shorts, are about to experience a margin call of historical proportions. They are watching the same signs: the accelerating depletion of registered COMEX inventory, the decoupling of Western and Eastern prices, and the absolute failure of the $81 paper line. They are now playing defense, hoping they can survive the inevitable surge past $100. But the math is against them. They are facing an army of physical buyers, backed by the strategic actions of a sovereign state. The $95 signpost simply marks the exit ramp from the paper world. Our destination, marked by the industrial necessity of a new, sustainable price, is $120. The short side of this trade, the bullion banks and the desperate paper shorts, are about to experience a margin call of historical proportions. They are watching the same signs: the accelerating depletion of registered COMEX inventory, the decoupling of Western and Eastern prices, and the absolute failure of the $81 paper line. They are now playing defense, hoping they can survive the inevitable surge past $100. But the math is against them. They are facing an army of physical buyers backed by the strategic actions of a sovereign state. The $95 signpost simply marks the exit ramp from the paper world. Our destination, marked by the industrial necessity of a new, sustainable price, is $120. Our destination, marked by the industrial necessity of a new, sustainable price, is $120. The $95 signpost simply marks the exit ramp from the paper world. They are now playing defense, hoping they can survive the inevitable surge past $100. But the math is against them. But let's talk about the fuel for this explosion. Let's talk about the Chinese Guillotine. Look back at the thumbnail, at that official-looking document in the background. It may look like a piece of bureaucratic minutia, but in the context of the global silver market, that piece of paper is a declaration of economic war. It is the game-over certificate for Western industrial supply. We are talking about the new Chinese industrial and trading license system, a policy change so precise, so cunningly executed, that it serves as the ultimate checkmate move against the West's reliance on paper promises. China is the world's largest refiner and processor of silver, controlling massive amounts of the final, usable metal needed for high-tech manufacturing. They don't necessarily mine all of it, but they take the raw material from all over the world and process it into the highly refined, pure silver grain, bar, and paste required for solar panels and electronics. This new licensing system, cloaked in the polite language of regulation and quality control, is, in reality, a strategic, non-tariff barrier. Let me dissect the terrifying genius of this. It's simple. By requiring mandatory export licenses with incredibly difficult high thresholds, China has found a way to nationalize and hoard its refined silver output without triggering a massive, immediate global outcry or a WTO sanction. They aren't putting up a huge, obvious tariff wall. They are using regulatory fine print as a weapon of mass industrial disruption. The fine print is the guillotine blade. To qualify for a license to export silver out of China, refiners now face ridiculously high barriers. They must prove, for example, that they have enormous annual production capacities, levels that immediately disqualify thousands of smaller, agile processors that used to feed the global supply chain. They also require massive, established credit lines, effectively ensuring that only the largest, state-affiliated or state-controlled giants can even attempt to pass the qualification phase. The result? A strategic strangulation. This maneuver instantly and surgically severs the Western supply chain. Think about it. A massive percentage of the global refined silver that London and COMEX used to rely on, whether directly or indirectly, suddenly dries up. It's no longer physically available to meet paper contracts. Where does that silver go? It gets diverted into China's own strategic reserves and its exploding domestic solar, EV, and defense sectors. This is not about market efficiency. This is about geopolitical resource warfare, securing a critical industrial input for the motherland while simultaneously starving your competitors. The implications for the London COMEX system are terminal. These Western exchanges already operate on razor-thin registered inventory. Their entire mechanism is based on the trust that when they issue a futures contract, they can eventually source the metal to deliver or roll the contract over. But the Chinese license system has fundamentally changed the underlying physics. It has taken a massive percentage of the globally available, deliverable physical metal and effectively put it behind a firewall. This instantly, violently drains a massive percentage of global available metal from the COMEX TOS London system. This single document explains why the $95 ATH was inevitable. The paper system was already sick, running on fumes and lies, but the Chinese move is the terminal disease. It means that every ounce of silver consumed by China's booming industrial base is 1 ounce that can never be delivered against a Western paper contract. The paper promises remain, but the physical collateral has been nationalized. The irony is breathtaking. The COMEX system, designed to control and suppress the price, has now been checkmated by a sovereign power using regulatory control to hoard the very physical metal the COMEX relies on. This isn't an accident. It's a cold, calculated strategic blockade designed to achieve resource dominance in the critical technologies of the future. They know that whoever controls the supply of silver controls the pace of the solar transition, the speed of 5G rollout, and the capacity for next-gen defense manufacturing. The paper traders can argue about candlesticks and technical indicators all they want, but the reality is this. A nation of 1.4 billion people has just chosen to keep its refined silver at home. This is the game-over move hinted at in the thumbnail. It is the definitive proof that the financial war is over and the industrial war is raging. And the only way the West can hope to break this blockade and force supply back onto the global market is through a price so high that China decides to sell its domestic supplies. Our Western industrial users are completely crushed. That price, as we established, is $120 and far beyond. The Chinese Guillotine ensures that the $95 ATH is merely the pre-show to a massive geopolitical price explosion. The Chinese Guillotine ensures that the $95 ATH is merely the pre-show to a massive geopolitical price explosion. This is the chapter where we stop talking about pennies and start talking about power. We must move entirely beyond the financial implications of this new license system and confront the brutal geopolitical implications of this move. This is no longer a conversation about an investment asset. It is a conversation about a strategic silver blockade that will cripple the high-tech expansion of the entire Western industrial economy. Silver, unlike gold, is not a luxury metal. It is the absolute irreplaceable workhorse of the digital and green economy. Its unmatched conductivity makes it a critical input for 3 pillars of modern strategic power: AI and data centers, solar energy infrastructure, and next-gen defense. Without silver, you cannot build a high-efficiency solar panel. Without silver contacts and solders, you cannot build the high-speed, miniaturized circuitry required for AI supercomputers or 5G infrastructure. And in the defense sector, in missile guidance systems and radar and in sophisticated sensors, silver is the only metal fast and reliable enough to carry the necessary current. Physics does not negotiate. There is no viable substitute that works as well, especially in the micro amounts needed for these applications. China's leadership understands this perfectly. While Western finance was focused on suppressing the price of silver, China was focused on controlling the flow of silver. They didn't need to control all the mines. They only needed to control the bottleneck. And they control the bottleneck. Market experts estimate China controls anywhere from 60% to 70% of the world's silver refining and processing capacity. By implementing a restrictive export licensing system, China has achieved a perfect strategic advantage. They are not merely prioritizing their own domestic needs, they are executing a deliberate, targeted industrial policy aimed at capturing the global supply chain. And this is the true reason the 120 price is inevitable. It's not driven by speculation, it is driven by a geopolitical hostage situation. China is essentially telling the rest of the world, you need our refined silver to power your solar transition, to build your next generation semiconductors, and to fuel your AI revolution. But we are locking the gates. If you want it, you will have to pay a price that makes you uncompetitive. The price must rise until it becomes so excruciatingly expensive that the West is forced into an economic crisis, or until our own, less efficient industries are forced to shut down because they simply cannot compete with China for the scarce physical metal. The price must rise until it's too expensive for the West to compete. The license system acts as a non-tariff barrier that surgically starves the COMEX and London vaults. It is a brilliant, silent form of economic coercion. Think about the ripple effect. A Western solar manufacturer needs refined silver paste. They cannot get it reliably from China anymore. They turn to the London or COMEX markets to buy a futures contract, expecting delivery. But the vaults are empty because the major source of refined influx has been sealed off by Beijing. The paper promises are worthless without the physical metal to back them up, and the price starts to disconnect violently from the actual cost of securing physical supply. The ultimate prize here is industrial dominance. By controlling the silver flow, China effectively controls the pace of Western high-tech expansion. If a U.S. defense contractor is suddenly facing a 400% increase in the cost of silver, or worse, delivery delays, their ability to produce mission-critical hardware is compromised. If European solar installations stall because silver paste is unavailable, the EU's climate goals become unreachable. This isn't just about money changing hands, it's about control over the future technological landscape. The $120 projection suddenly becomes a matter of national security, not just market analysis. It is the price required for the Western industrial complex to even start to compete with the sovereign hoarding now underway in China. It is the price that forces global OEMs to panic buy, to hoard, and to secure long-term mining contracts, anything to ensure they don't lose the technological race to the east. This geopolitical pressure transforms silver from a speculative trade into a strategic asset that nation-states are now scrambling to secure, confirming silver's status as a critical mineral. The Chinese Guillotine, triggered by a simple regulatory document, has set the world on a path where the paper system burns, and only the physically secured sovereign survives. The Chinese Guillotine, triggered by a simple regulatory document, has set the world on a path where the paper system burns, and only the physically secured sovereign survives. Now we are going deep into the financial plumbing, into the dark heart of the COMEX paper-to-physical collapse. Look back at the image of the burning contracts, and you are looking at the mechanism of a bank run. This entire silver pricing structure, as dictated by the Western exchanges, is based on a fractional reserve system that makes commercial banking look conservative. It is well documented that less than 1% of futures contracts ever result in actual physical delivery, and the paper-to-physical ratio, the amount of paper ounces sold versus the amount of physical ounces available for delivery, has been hypothesized to be anywhere from 356.1 to higher in periods of acute stress. This is the Achilles heel of the system. For decades, the bullion banks exploited this imbalance. They could sell an unlimited stream of paper promises, effectively shorting the price far below its true physical value. They were playing with fire, and the $95 ATH is the siren going off inside the vault. That price is not just a technical breakout, it is the inciting incident that finally catalyzes the long-feared run on the physical vault. Here, as the mechanism of the collapse, when silver was stuck at $20 or $30, no one cared about delivery. Industrial users and speculators were happy to roll their paper contracts over for a cash settlement. Why take the hassle of storing physical bars? But now, as $95 proves the momentum is real, and the Chinese licenses show the physical supply is about to be politically blockaded, the mentality shifts instantly from cash settlement to delivery demand. This $95 price is forcing a wave of buyers, both savvy retail investors and, crucially, panicked industrial users, to issue what's called a notice of intent to take delivery. They are saying, I don't want your paper promise anymore, I want my metal. When a bank, or in this case, a bullion bank short seller, is forced to deliver physical metal against a futures contract, they must have that metal stored in an approved depository. But because they are short 356 ounces of paper for every 1 ounce of physical they hold, this sudden collective demand for delivery creates a cascading, unavoidable crisis. The short sellers cannot find the physical bars. The COMEX registered inventory, the sliver of silver actually available for delivery, starts to bleed out at an alarming rate. We are talking about tens of millions of ounces being pulled from the vaults since the beginning of this rally. The paper-to-physical trust has been shattered. Banks that cannot meet the delivery demand are technically forced to default on delivery. Now, they won't call it a default, they'll call it a cash settlement forced by force majeure or a technicality. But to the physical holder, it means the price they were told was real. The paper price was worthless, because it couldn't buy the physical asset it promised. This brings us to the final squeeze, the mechanism that will accelerate the price toward our $120 target. The short sellers, desperate to avoid defaulting, must liquidate their massive paper short positions. To liquidate, they must buy back their paper contracts. But here is the beautiful symmetry of the squeeze. Every single attempt they make to sell paper short is now met with a physical buyer, an industrial entity or a smart institution that is immediately converting that paper to delivery intent. This forces the bullion bank to cover their short by buying metal at a higher price, which accelerates the price up, which triggers more delivery requests, which accelerates the price further. It is a vicious, self-feeding cycle. The entire system is a house of cards, where the paper value is continuously being debased by the physical reality. The burning contracts in the image perfectly symbolize this. They are the fiat promises of the financial system, the debt and leverage, going up in flames because the physical commodity, silver, has reclaimed its status as true, non-negotiable scarcity. The COMEX is not a reliable price discovery mechanism. It is a giant, over-leveraged short position that is currently imploding under the weight of real-world industrial demand and strategic geopolitical action. The price must rise to $120 to successfully shut down this short squeeze mechanism by making it too expensive, too painful, and too risky for the banks to continue defending the paper fiction. The paper system has run its course, and its funeral pyre is raging. The paper system has run its course, and its funeral pyre is raging. But the final, undeniable proof that the paper fiction is dead comes from the global wire, specifically from the price feed streaming out of the East. This is the story of the global arbitrage death, the definitive, quantifiable evidence that the price you see on your screen, the COMEX price, is a ghost. It is a price that no longer reflects the cost of securing physical metal anywhere in the real world. The core of a unified global commodity market is the arbitrage mechanism. This is a simple, beautiful concept. If the price of silver in London is $95 and the price in Shanghai is $100, a savvy bank immediately buys low in London, ships the physical metal to Shanghai, and sells high, pocketing the $5 difference. This action simultaneously lowers the price in Shanghai and raises the price in London, instantly snapping the two markets back together. This mechanism guarantees that the price of silver, accounting for shipping and insurance, is essentially the same everywhere on the planet. When arbitrage dies, the market decouples. Well, ladies and gentlemen, the arbitrage mechanism for silver is now officially dead, murdered by the combination of chronic Western supply deficits and the new Chinese licensing blockade. The evidence is overwhelming. Silver is already trading at a massive structural premium in Shanghai and other Eastern physical exchanges compared to the COMEX price. We aren't talking about a small transient $1 difference. We're talking about a significant persistent gap that has been widening relentlessly since the $95 breakout. This gap, this terrifying disconnect, is the ultimate confirmation of the paper decoupling. Why are the banks not arbitraging this difference? Because they can't. They would love to buy cheap paper silver on the COMEX, take physical delivery, and ship it to the East to capture the massive premium. But the vaults are empty, the metal is gone, and the Chinese Guillotine has sealed off the final destination. Here is the nightmare for the bullion banks. To arbitrage, they would have to buy paper silver demand, physical delivery, which is already causing the short squeeze, find insurance and logistics willing to ship a strategic metal to China, and then try to sell it into the Shanghai market, which is controlled by the very government that just restricted exports. They realize that the paper they bought on the COMEX is becoming functionally useless for global physical trade. The risk of trying to buy physical in the West and ship it east is too high, the cost is escalating, and the supply needed to make the arbitrage profitable simply doesn't exist outside of the sovereign sphere of influence. What does this mean for you, the investor? It means the $120 price is already implied by Eastern physical market movements. When the Chinese domestic price consistently trades at a 10% or 15% premium to the COMEX, what that tells you is that the real scarcity price, the price being paid by the largest industrial consumers on the planet to keep their lights on, is already significantly higher than the price dictated by the collapsing paper exchange in New York. The COMEX is reporting a theoretical paper price, while Shanghai is reporting the physical cost of survival. The East has functionally decoupled from the West, and the COMEX is now only trading its own internal fiction. This arbitrage death confirms that the $95 ATH was not an overreaction. It was the West beginning its desperate, belated attempt to catch up to the reality that the East has already priced in. The West is now being forced to bid against itself and against a sovereign nation that has the ability to nationalize its supply. The only way to close this massive structural price gap is for the COMEX price to violently spike upward until the arbitrage becomes impossible for the banks to ignore, or more likely, until the COMEX system simply breaks under the strain. The irony is thick. The West's control mechanism is being destroyed by the very market forces it was designed to contain. By holding the price too low for too long, the COMEX allowed massive physical deficits to accumulate, which China exploited perfectly. Now, the natural price discovery of the physical market, primarily expressed in the massive premiums in the East, is coming home to roost. The decoupling means that global capital is facing a binary choice. Trust the collapsing Western paper price and risk being unable to take delivery, or pay the premium demanded by the East and secure the physical metal that runs the future. The smart money is already choosing survival. They are looking at the Shanghai premiums, they are looking at the new Chinese licenses, and they are doing the math. The math screams that the only sustainable global price that respects the industrial demand and the geopolitical blockade is well over $100. $120 is the convergence point where the COMEX price must meet the true physical scarcity price currently being paid in the East. This is not speculation, it is the ultimate expression of the market correcting its own fraud. The death of arbitrage is the lifeblood of the coming parabolic price explosion. The death of arbitrage is the lifeblood of the coming parabolic price explosion. The death of arbitrage is the lifeblood of the coming parabolic price explosion. We have deconstructed the lie, witnessed the paper system burn, and identified the geopolitical weapon aimed at the heart of Western industrial supply. Now we arrive at the most critical moment of this entire narrative, the investor transformation. This is not about trading, this is about survival. This is about becoming a $120 silver sovereign, moving from a common speculator, playing the bank's rigged paper game, to an autonomous holder of a strategic, unencumbered asset that nation-states are now scrambling to secure. The final advice is simple, yet profound, and it is the only viable path forward in a world where financial fraud and geopolitical blockades have become the new normal. You must fundamentally change your identity from a paper trader to a physical realist. You must position yourself for this coming explosion by securing metal that is immune to COMEX fraud and impervious to Chinese blockades. First, let's address the price. $120 is not the ceiling. It is the temporary industrial floor. We established that $120 is the price required to ration industrial demand and force a meaningful supply response. But once the price hits this level, the true market recognition phase begins. You must view any price above $95, including $122, as a transitional period, the necessary volatility required to establish the long-term trajectory. The trajectory is driven by the fact that the entire fiat system, represented by the burning paper, promises we saw in the thumbnail, is failing. As confidence in paper currencies and digitally conjured wealth collapses, the flight to hard, irreplaceable industrial assets like silver becomes a structural, multi-decade event. Your long-term focus should not be on taking profits at $120, but on using the physical silver you own as an inflation-immune geopolitical hedge against the inevitable devaluation of everything else. The key to sovereignty lies in unencumbered physical metal. If your silver is held in a bank vault under a paper certificate, in an ETF that uses COMEX futures, or in a pool account where you are a fractional owner, you are still a paper holder. You're still exposed to the very fraud and delivery risk that we detailed in Chapter 5. To be a silver sovereign means holding metal that is completely segregated, legally titled in your name, and physically accessible to you. It is the only way to opt out of the financial and geopolitical turmoil. This physical holding is your insurance policy against a banking system that has proven it cannot deliver, and against a foreign power that is now actively using the global supply chain as an industrial weapon. This fundamental transformation is the engine of the greatest wealth transfer of our lifetime. For the last 40 years, wealth has been transferred from physical metal holders to paper holders, leveraged by the bullion banks. They sold the physical metal off cheap to industrial users, and then printed paper contracts to cover their shorts, enriching themselves in the process. Now, that cycle is violently reversing. As the paper system implodes, wealth is being ruthlessly transferred back from the desperate short sellers and collapsing paper institutions to those holding the real scarce commodity. This transfer is not happening gradually. It is happening in the parabolic shock phase driven by the $95 ATH and the Chinese Guillotine. Consider the long-term trajectory. Silver is not just an investment, it is a critical component of every major technological shift. AI, green energy, and 5G. The demand is exponential, and the supply is finite and geologically constrained. This is a recipe for a sustained price trajectory that goes far beyond any temporary peak. $120 is simply the price required to momentarily halt the industrial panic. The true ceiling is determined by the cost of substitutes and the ultimate debasement of the fiat currencies used to price it, a number that could push the metal to multiples of its current value. Your role as a silver sovereign is to maintain your position, viewing your physical metal as strategic capital rather than a financial speculation. This means do not sell the insurance policy. This is the moment to secure your future by holding an asset that the world suddenly realizes it cannot live without. The geopolitical war over physical supply is raging, and by holding physical metal, you're standing on the side of reality and non-negotiable scarcity. You are holding the ultimate strategic asset, one that will increasingly be valued not in fleeting dollars, but in its ability to guarantee production, power, and prosperity in a collapsing paper economy. The paper market is irrelevant. The $95 ATH is old news, and the price explosion is fully underway.